If the US and Iran slide into full-scale conflict and oil breaks $100, the market's rate cut fantasy does not pause. It gets repriced. Do not let the phrase geopolitical risk lull you into thinking this is a distant headline. This is not an abstract foreign policy story. This is a shock that can hit your borrowing costs, your job market, and your grocery bill through one brutal channel: energy. Now picture it. Iranian energy infrastructure is hit, and the Strait of Hormuz is threatened. Let's get the key facts straight. It is not that 20% of global oil supply disappears overnight. That is a sloppy soundbite. The real issue is that roughly 20 million barrels per day of oil and petroleum products move through Hormuz. That is about 1/5 of global liquid fuels consumption. It is a choke point, a narrow corridor that prices the world. And here is the part most people miss. The fear is not only the barrels, it is the premium. Markets do not wait for a full blockade. They price probability. Even a rising chance of disruption can spike war risk insurance, push shipping routes longer, tighten tanker availability, and lift freight costs across the entire supply chain. That cost does not stay on the ocean. It lands in manufacturing, retail, food logistics, and household budgets. So the real problem is not the gas station sign. The real problem begins in the Federal Reserve's decision room. The Fed's mandate, in practice, is maximum employment and price stability, with an eye on longer run rates. But oil at $100 is a stress test that attacks both sides of the mandate at the same time. And it does it through one concept that matters more than your favorite chart: expected inflation. Oil can rise for a week and fade. That is noise. The dangerous moment is when people start believing the rise will stick. When households believe prices will keep climbing, they pull spending forward. When firms believe costs will keep rising, they raise prices faster and more broadly. When workers believe inflation is becoming the new normal, wage demands harden. That is how expectations turn into reality. This is why bad growth means rate cuts is not a universal rule. It depends on what is driving inflation. If inflation is demand-driven, central banks can cool demand. If inflation is cost push, caused by a supply shock, cutting rates can pour oxygen on the price fire while growth is already weakening. That is the nightmare mix: slower growth, sticky inflation, and fewer clean policy options. Now let's talk mechanics. A sustained oil shock can lift headline inflation meaningfully, and then it can leak into core through transport, materials, services, and wage dynamics. Not instantly, but predictably. If oil moves from the $70s to $100, that is a large percentage shock. Even if you do not argue about the exact number, the direction is the same. The inflation path steepens. The Fed's runway for cuts shrinks. And once the inflation runway shrinks, the market's pivot story becomes fragile. Because the Fed does not only respond to current inflation, it responds to the risk that expectations break loose. That is the real trap, not the price level, the credibility line. So let's map the scenarios, not predictions, a risk map. Scenario 1. Limited strikes. Hormuz stays open. Oil spikes into the $90 to $100 range. Volatility jumps, but physical flow continues. In that world, the Fed is less likely to rush into cuts. It will want confirmation that inflation expectations remain anchored. And markets will do what they always do first. They will move long-term rates. That is the transmission most people feel before they can even explain it. 10-year yields move. Mortgage rates reprice. Corporate borrowing spreads widen. Rate cuts can get pushed out, not by a Fed speech, but by a changed inflation path. Scenario 2. Partial disruption or prolonged tension. Not a clean closure, but enough uncertainty and enough friction to keep oil elevated. Think a $110 to $130 range that lasts. This is where second-round effects start to matter. costs seep into services. Firms rebuild margins. Wage negotiations get tighter. Core inflation becomes harder to cool. In that world, the Fed's default becomes higher for longer. Not because it enjoys pain, because letting expectations drift is worse. Scenario 3. Physical blockage or severe disruption. This is the tail risk, the shock that can open extreme price ranges. In that world, the market starts pricing the ugly word again. Stagflation. Growth slows because energy is a tax on a real economy. Inflation rises because the supply side is constrained. And policy becomes a trade-off, not a solution. This is where people bring up the 1970s, not as a history lesson, but as a reminder of what central banks do when credibility is on the line. They prioritize the anchor, even if growth takes the hit. Now, you will hear a common counterargument. Shale will save us. Here is the problem. It is not only geology, it is capital behavior. In the current era, many producers focus on capital discipline. They prioritize shareholder returns, balance sheet stability, and measured reinvestment. Supply does not surge instantly just because prices spike for a month. There are lags, constraints, and incentives. So the simplistic equation, higher oil equals immediate supply, flood equals easy disinflation, often fails when you need it most. Now bring it back to your life. Oil shocks hit expectations. Expectations hit long-term yields. Long-term yields hit mortgage rates and corporate funding. And corporate funding hits hiring. That is the chain. The most fragile position in this chain is leverage built on a single assumption. That rate cuts are guaranteed. That refinancing will stay available. But the cost of money will fall on schedule. When refinancing closes, even good assets can become bad assets because cash flow becomes the only judge. And when cash flow tightens, forced selling begins quietly, then all at once. Companies behave the same way. Higher input costs plus higher funding costs equals margin compression. The first response is cutting discretionary spend, then CapEx, then hiring freezes, then layoffs. Not ideology. Accounting. There's also a macro layer most people prefer not to discuss. High debt makes trade-offs sharper. Keeping rates high for long can stress fiscal dynamics. Cutting too early can reignite inflation and weaken confidence. An oil shock makes that tightrope thinner. So what do you do with this? You stop watching headlines like entertainment. You watch the transmission points. Watch inflation expectations like break-evens. Watch long-term yields. Watch credit spreads. Watch shipping and war risk indicators. Watch how quickly oil moves and how long it stays elevated. Then run a personal checklist. 1. Is your debt fixed or floating? 2. Can you survive a refinancing freeze? 3. Do you have cash flow resilience, not just paper gains? 4. Is your portfolio built for one narrative or multiple regimes? This is not fear. This is pricing. In markets, risk becomes a number, and the people who survive are the ones who read the price tag before the crowd does. After Hours Alpha. If this made your thinking sharper, hit like, leave a comment, and I'll ask one thing. I'm embarrassed to ask, but subscribe once. In an oil $100 world, does your financial life run on hope or on structure?